Are you a high rate taxpayer looking to invest in property? Well, you want to watch this video as I show you how to set up a tax efficient structure. Hi there, my name is Misiewicz from Optimise Accountants, and I today want to give you the most tax efficient structure if you are a high rate taxpayer looking to invest in property. So let's get into the slide deck. So let's get into the slide deck about investing in property in the most tax efficient way. And this is for high rate taxpayers only. So mortgages and Section 24. Why should you care about Section 24 mortgage interest relief cap if you're a high rate taxpayer? Before we go into the details, if you want to know more about Section 24, then go and watch this video. A link should be appearing above my head, so you can go ahead and watch that at any point in time. I want to talk about being a high rate taxpayer now and investing in property. What's happened and how does it affect your tax position? Well, before 2016-17, Section 24 mortgage interest relief cap didn't even exist, or it didn't affect your tax position at the time. But if we forward now to 2021, then Section 24 mortgage interest relief cap will be in full flow, which basically means you cannot offset your mortgage interest cost against your property income. That is a bummer. So the thing I want to bring to your attention is that Jane is a high rate taxpayer and she's got a property that's situated in London and she's hoping on capital growth. Now, as you can see, Jane in 16-17 has made a loss of £1,500. The problem is with this is that if you forward on to 2021, she has now got a paper profit of £6,500, which isn't real money, but she is going to be taxed accordingly. So as you can see, she's got a 40% tax bill of £2,600. She will get a tax reducer of £1,600, which is 20% of the mortgage interest cost. So 20% of mortgage interest cost equates to £1,600. But it does mean that poor old Jane, who's a high rate taxpayer, has now got a tax liability of £1,000, even though she has not made any money at all. And in fact, that £1,000 tax liability is going to be in addition to the loss or cash outflow of £1,500, meaning that poor Jane has got a cash outflow now of £2,500. And that is the issue that surrounds mortgage interest relief cap for high rate taxpayers. You are likely to pay more tax than you ever did before. But the problem doesn't stop there, because of the rebasing of the taxable income for Jane. Let's imagine she had employment income of £40,000. The rental profits of £10,000 would mean she got taxable earnings of £50,000. She's a high rate taxpayer, but there are no implications of child benefits. Forward March now to 2021, and those child benefits that she had is going to be taken away from her. So she's going to have a tax liability to pay back the government for those child benefits from which she's really entitled to. So that is a major problem. It gets exacerbated, and let's imagine that Jane now had a salary of £85,000 back in 2016-17. It doesn't really increase too much when inflation stays as it is, and the property portfolio taxable income is being rebased. She now loses her personal allowance, which right now is £12,500, which you can earn and you have no tax. So £12,500, you can have that and there'll be no tax to pay in this country. However, because of the recalculation, Jane now loses her personal allowance, which is an effective tax rate of 62%. So that's a major burden that she has now got. And I always said to people that Section 24 mortgage interest relief cap is going to be a compound effect because mortgage interest rates right now are very low. I rather suspect though that mortgage interest rates are going to increase, and that means that there's going to be more tax and more mortgage interest. Who's going to win? It's going to be the HMRC and the banks that make more money than you. And that is unfortunately the case if you invest in property with a mortgage in your own name. Now, the one thing I want to bring to your attention is that this is a great example, not a great example as in a positive, but it just illustrates the point in fact. We have an additional rate taxpayer who's a genuine client of ours who had a tax liability of £15,750 on the property profits of £35,000. You can see yourself that he had a tax liability as additional rate taxpayer of 45%. However, because of the rebasing of mortgage interest relief cap, etc., that percentage of tax is now going to be 77%. And in some cases, we've had basic rate taxpayers who are heavily leveraged being moved from a basic rate taxpayer to a high rate taxpayer, and they're going to be paying, wait for it, 145% in tax. That's right, 145% in income tax on their property portfolio. To put that into context, this basic rate taxpayer could make £10,000 worth of profits, but end up paying more than £14,500 over to HMRC. What a disappointment that is going to be on their property investment journey. So I've created an online portal where it'll help you to understand how you can save SDLT when you're buying a property, value-added tax when you're buying a commercial building or indeed refurbishing a property, the income tax and corporation tax that you can save when making profits on your property portfolio. So make sure you enroll today and start learning how you can save tax on your property portfolio. Now, this brings me to my point of investing with no mortgages. Why should I mention that? Well, before I talk about investing in property without a mortgage, I do need to give you the benefits, the upsides of using mortgages. And the first one is clearly leveraging of debt. You could have a property unencumbered for £100,000, but it requires you to have £100,000 in cash, which might take you some time to save up for. So in the meantime, you might decide, well, let's get a mortgage instead. I've got £25,000. It does not stop me from getting on the property ladder just because I do not have that full £100,000. I mean, let's be honest, who has £100,000 just lying around on their bedroom floor? Not many people. So using mortgages is a great way of getting onto the property ladder, and it just means that you get there a lot quicker. Now, the other side to that, it gives you better return on investment. Because you are using less of your own money, the returns are still there, therefore you should be generating a greater return on investment, which for a lot of people, that matters a lot. But I do want to highlight the fact that there are some disbenefits of having a mortgage, especially as high rate taxpayer. The first one is the fact that you've got to pay back your mortgages. So if you've got a mortgage, they do need to be paid back, unfortunately. And if you pass away, you've got 12 months whilst you pay back those mortgages. Not you, but your estate, during the time that they're trying to be grieving for you. And if they're unable to sell the properties because you do not have enough cash to pay off those mortgages and it's a recession, wow. They've got the stress of you passing, mourning your death, and now they've got the added tribulation and stress of selling properties in a down market to pay down the mortgages that you have. It could leave you with zero estate altogether. We must also consider interest rates are right now very low. I'd expect that mortgage interest are going to increase, and therefore that's more money going out of your investments to other institutions such as the banks. We do need to bear in mind that HMRC have already taken their lion's share, and the banks may end up taking even more in the future. Delays in mortgage applications. I'm a property investor just like yourself, or want to be an investor. You may not be on the journey, so you do need to be aware that there's a delay in mortgage applications. You've got issues such as the mortgage lender themselves might not want to loan to you because you're inexperienced. They may not want to invest in the property because, well, in their opinion, it's risky. And therefore there's delays in the entire process, which gives you more added problems. Section 24, as we said before, you cannot offset the mortgage interest cost entirety, therefore you'll be making more profit or paper profits in the eyes of HMRC, and you could end up giving all of your profits to HMRC. So as I said, let's go with an example now of buying a property with and without a mortgage, and let's just see what the financial impact really is. You've got a taxable income of £10,000 on a particular single let property, and in both examples you've got a tax rate of 40%, no real change there, and you're paying £4,000 tax. In the first example, you do have a mortgage, so you do get this £1,200 worth of tax reducer, which basically means you pay tax at £2,800, which is reduced to 28% in effect, instead of 40% with no mortgage. However, once you take your net income, and that's before tax, you've got your tax liabilities as shown on the screen there. You've got now a net cash position of £1,200 because you have got a mortgage, and you've got £6,000 if you do not have a mortgage. Now you can see the contrasting numbers there. If you do not have a mortgage, you are going to be making more absolute cash returns than you would do on having a mortgage, which really people looking for ROI would be more interested on the 1,200 because they could be buying 4 of these properties, which in effect could mean £4,800 return versus £6,000. But again, we do need to think about what your plans are for the future. Are you more interested in absolute cash return and having quite a life? Because let's not forget, if you've got 1 property versus 4 properties, well, that's quite a life in itself. Do bear in mind, as I said before in this example, that a high rate taxpayer will be paying maximum of 40% tax. I know I give the example of 45% additional rate taxpayer here, but their tax liability would be increasing to 77%. But if you are a high rate taxpayer, which is where this video is positioned, you're likely to pay no more than 40% until you get to be an additional rate taxpayer of 150%. So over £150,000 taxable income, which you would have a 45% tax liability. But still, it is a lot less than what the impact could be with a mortgage of Section 24, where it could go to 77%, even if you're not moving to being an additional rate taxpayer. So you do need to think about your strategy, your approach of using mortgages. Is it really worthwhile? Drop your questions in the comments box below and I'll make sure I get to answer those as soon as I can. And let's talk about limited companies and using property investments. What I want to do is show you that this video, which should be looking above this link above my head right now, you can watch that to see if you should indeed use a limited company as a high rate taxpayer or because of Section 24. Watch that video, really insightful, a lot more detailed than what I'm going to go into right now, but I wanted to focus just on high rate taxpayers in this video. Alright, so in this example we've got now 2021. Why is this important? Because of Section 24 takes full effect in that tax year. We also must remember that the corporation tax rate is going to drop from 19% down to 17%, which is also very important to note. What we are going to do now is compare the in your own name property investment and if you had a limited company. The first example we're going to use is if you had a limited company but you wanted all the money for your lifestyle purposes, which basically means whatever the limited company makes, I want to use for my personal benefit. Alright, so given that, if you had property in your own name, as I said before, ignoring mortgage interest relief cap and Section 24, we're going to assume here that we have no mortgages in place at all. So in that regard, if you have £100,000 worth of profits in your own name for those properties, you're going to have a tax liability of £40,000. Easy enough numbers because it's 40%. However, if you use a limited company and it had £100,000 worth of profits, it would be subject to £17,000 tax, which is 17%, which leaves you with £83,000. Now, you might be wondering, why have I left £81,000? And that's because £83,000 less £2,000 worth of dividends, which is tax-free, leaves you with £81,000, which would be taxable from a dividend perspective, which is taxed at 32.5%. Which you can see there, we've got a corporation tax rate of 17%, £17,000, and a personal income tax rate of 32.5% on those dividends of £81,000 that you're extracting, giving you a tax liability in total of £43,325. Sorry, £43,325. And that basically means that using a limited company at all in this way is a crazy nonsense way to do things, because you are likely to have the administration, the accountancy fees for that limited company, and you've saved not one jot of tax. So does that make sense? No, of course it doesn't. Where it does make more sense is whereby you've got the same example, £100,000. In your personal tax, you will have £40,000 of tax liabilities. Now, if you had it in a limited company, same £100,000, but this time around, we're going to just extract £20,000 and leave the bulk of the money in the company. And that means that that would be used to reinvest in more properties going forwards. So £18,000 would be taxable because the £2,000 worth of dividends is tax-free, which basically means that you've got an ultimate tax bill of £22,850, which is significantly less than having the properties taxed in your own name, because all of the properties profits would be taxed irrespective if you reinvested the money or not. And that is why it's a great way to use a limited company if you are looking for long-term investment strategies. I appreciate there's a lot of detail, so if you've got any clarification questions on those points, please make sure that you type in those questions below this video and I will get back to you as soon as I can. If you liked what you saw and you're looking to invest in property but in a most tax efficient way, you could talk about our services, setting up a limited company for you for free. And you could do that on www.optimiseaccountants.co.uk to find out how we can deliver services for you. Or if you just want some tax questions answering, you can spend 60 minutes with me on the phone, uploading your questions ahead of time. I will do all my research before the call and talk to you just about the solutions. You can do the same using www.optimiseaccountants.co.uk, using the code U225 to get 25% discount, and speak to me for a full hour plus all the time I'm doing the research for just £300. You can't say fairer than that given the amount of tax that I can save you. So again, my name is Simon Misiewicz from Optimise Accountants, and I look forward to seeing you again very soon on the next video.